does it cost to sit for our consultations, to come meet with us and figure out a tax plan, or if there's something we can help our clients with?
There's never any type of charge for those services. What we do is a consultation with you. We will figure out if we're a good fit.
Maybe multiple consultations.
Whatever it takes to help you get the plan in place. But we don't charge a planning fee, and we don't charge an hourly fee. We get paid, we are fee only, and we get paid fees based off what you have invested with us. And then obviously any insurance products that we do. So there's nothing coming, what we would say, out of pocket on your end.
We're dual licensed. Both of us are dual licensed.
Yes. Meaning that we're insurance licensed and our securities licensed. So this real tax system that we're talking about today is complex in retirement because required minimum distributions is one topic. Capital gains, we talked about how that's taxed differently than how your ordinary income is taxed. Social Security benefits. In this next little segment, I'm going to try to explain to you how Social Security is taxed. It's not based on how much you receive in Social Security. Wouldn't you think that if Frank is getting $3,000 a month from Social Security and I'm getting $1,000 a month in Social Security, isn't it most likely that Frank is paying more in Social Security tax than me? Not necessarily, because that's not how the tax is determined. It's not that simple. So, Medicare premiums. Medicare premiums are based off of your income. How much you pay in premiums is based off your income. We're going to touch on that a little bit. And potential Roth conversions. We talked about that in that opportunity and how we use the progressive system to take advantage of any gaps, fill in the gap up to, or just go ahead and fill up that bucket in that lower tax percentage. And then wait until the next year and do it again and keep doing it. You know, a Roth conversion is usually done over several years, not just in one lump sum. Okay, so let's talk about required minimum distributions. One of the things about required minimum distributions is that they're required. Once you get to that part of your life and who knows what it's going to be, they've recently started changing the dates. But when you have, and rather than making it like age 70 or age 75, something easy people can remember, they make it like 72 and a half, 73 and a half, or up until April of the birthday before you.
It's the year after you turn 65, April.
Yeah, it's like a weird, it's always weird. So look up the exact, it is now, I think it's 73 and a half. So anyways, but you are going to get to that point. And if you have an IRA, so an account that you have been deferring paying your ordinary income tax on this money all this time, Uncle Sam is coming for it now. He is involved. He wants to receive his portion. So how does he do that? The government requires you to start taking a minimal distribution. Hence the word required minimum distribution. So it's like forced income out of that account. And that portion, like the chunk that they make you take, the amount of income that they force you to take increases every year that you age. Go ahead.
So you cannot, this is from the IRS.gov, you cannot keep retirement funds in your account indefinitely. You generally have to start taking withdrawals from your IRA, simple IRA, SEP IRA, or retirement plan account when you reach age 72, 73 if you reach age 72 after December 31st, 2022.
Exactly. So what you do with these, in order to calculate your required minimum distribution, it is the value of your account the prior year end. So for example, what you would take in 2023 is going to be based off how much your account was worth December 31st, 2022. And then you're going to divide that by your life expectancy, which is not a number that you get to make up. That's a number that Uncle Sam makes up. So in this example, a person 73 years old with $500,000 as of December 31st, 2022, divided by 26 and a half, their required minimum distribution would be $18,868.
And how old were they?
73.
73.
Now, the thing of it is that life expectancy continues to go up and up and up and up. And the more that you are required to receive is dumping more money into the next bucket and the next bucket and the next bucket. Because the larger the sum is, you're no longer doing this trickle effect, you're getting a force. And it usually happens when I really see accounts start to get drained out and taxes increase on it, where it really starts to implode. It's kind of like your early to mid 80s. Things change because those forced distributions become pretty big. So that's why we want to create a strategy to offset that. And the thing about planning for required minimum distributions is that it's so easy. People have these huge IRAs. They don't realize they're walking around with a big debt attached to their investment. You owe the government this money, and whether you pay them bit by bit or you pass away before you pay them, which means in death, it's going to go.
Taxes.
The government, the account. The account is going to go to your beneficiary. Maybe it's your spouse, maybe it's your children, but that debt follows that money. It doesn't just go away when you die. It carries on. So do those required minimum distributions. But it's easy to plan for if you know what you're doing, because we know what it's going to be. It's almost like a fixed thing, and we want to offset that. There's a few strategies. One way is that they're going to drain this account. So we used fixed indexed annuities to create a lifetime income, so that at some point your required minimum distribution and this lifetime income rider, it's called, they will start to match up. And when they match up, then we lock in that lifetime income rider. And that usually happens, maybe, let's say you set it up and you're 70 years old and now you're 75, we lock in that rider. And these are hypothetical. The numbers are always different, and we watch it year after year and know when to kind of click the button to make sure that we're getting the absolute maximum income and offsetting this required minimum distribution. So then what happens is then the required minimum distribution gets bigger and bigger, your account value gets lower and lower, but that income is locked in for the rest of your life. The insurance company then is forced to distribute this money no matter what, and now you have a lifetime income, and if you do live to be into your 90s, guess what? You are winning, because now that money is just pouring in, and your account value could possibly be to zero, but you're still getting income from an IRA that, it's a win for you.
Right. This is a strategy you're talking about where this is just one component of the overall retirement plan, using this annuity to help.
For an IRA.
Yeah. But there's like many of the individuals we're talking about have also other assets in their portfolio.
Oh.
That are, we're not talking about a single standalone stovepipe strategy. No, this is
it's always part of an overall. It's really what I call like an arrow in your quiver of arrows. It's just one strategy that might be a good fit in an overall plan. But yeah, you're right. You might have 5 or 6 different strategies working.
Policies with these annuities could have all kinds of stuff going on.
That's
the same person that we're talking about.
Absolutely. For example, another strategy just for the IRA purpose is what we were just talking about a couple nights ago with another family. One, they know they're going to be leaving their IRA to their daughter, and just one heir to that amount of money. They have plenty of other money, but they have this one IRA, and it's carrying quite the tax burden. And so what we're going to do is create a life insurance policy that those required minimum distributions will pay the life insurance premium for the life insurance policy. Now, why life insurance? How does that make sense? Well, guess what? Life insurance benefits. So if I die and I leave Frank $1 million in life insurance, guess where that falls in all of this tax discussion?
Zero.
Nowhere.
No taxes.
It is 100% tax free. So it's an incredible tool to use when you're trying to develop a tax strategy. So why not? And here's what can happen. So I have a client right now. She has an IRA that we set up years ago. The required minimum distributions pay for the life insurance premium. And now in her 80s, she has this life insurance policy that's worth far more than the IRA is now. And the IRA is still paying for it. And when her kids inherit the life insurance policy, there will be no tax burden. There will be no income, because what happens when that lump sum comes in, it's going to get thrown into their higher income bracket because most of them are working. So if you're in your working years and you're already making $120,000 or $130,000 and then you inherit $500, it's getting taxed at a high bracket. So why not take care of that problem before it's a problem? And it's so easy to do with the life insurance if you don't need the income from the required minimum distribution. So there's two little strategies that are, again, arrows in our quiver. Am I saying that right?
Right.
Yeah. that we can use to help you offset tax burdens. So let's talk about Social Security tax, because I do want to touch on that before we end today. Social Security, when you're trying to figure out, why am I paying so much in taxes on my Social Security? I only get this much and then they tax me this much. Some people are in this position where they actually are paying quite a bit in taxes on their Social Security, and then other people are paying nothing. And it's all because of the strategy, the plan, and it's just like how the cookie crumbles, as they say. So Social Security is not taxed based on how much you get in Social Security. It would make it way easier. No, we like to make things complicated here in the United States. So Social Security is taxed like this. You have to take 50% of your Social Security benefit. Okay? So take half of how much you're making. And then you combine that with how much you received in income, ordinary income. And then add that to any dividends or capital gains that you received. And then add that to any non-taxable interest. So, you might say, I have tax-free bonds. Well, they count here.
Like municipal bonds.
Yeah, the only thing that doesn't count is from your Roth. So if you have a Roth IRA, it's the only thing that doesn't count in here.
Or loans from a cash value.
Or loans that you're taking from your big whole life
or
cash value.
Distributions from cash that as long as you're under the cost basis out of a life insurance policy, you can take a partial withdrawal.
Yes. I like the loan idea better. But okay, life insurance, income from life insurance. We don't want to get too confused. So, but that could also not count, but it's not considered income anyways. But it's a valid point. It's a very good point. Benefits. So here we go. If you're going to calculate this, I'm going to use this example and I'm going to read it right off. I wonder if I can do it here. Okay, so we have.
While you're doing that, you may want to call in. You have a few minutes left to the Mindie Molina Show. You can reach us here at the station at 772. This is a live program. 772-221-1100. And you can find us at mindiemolina.com. It's MINDIEMOLINA.com. mindiemolina.com if you'd like to reach out to us as well.
Okay, let's see if I can make this make sense over the air, because it's confusing on paper, let alone without a visual.
Security tax and how it's calculated with an example.
So,
go for it, Mindie. Example
number one, this couple is receiving $20,000 in Social Security, and they're taking $40,000 a year from their IRA. Going back to those required minimum distributions, this is another issue with taxes as people age. Again, when you are getting those big forced withdrawals, like you might not need $40,000 in IRA income, but the government's making you take it, and now it's affecting your provisional income. So how they calculate this for the provisional income is, again, you take half of the Social Security. In this case, $20,000 divided in half is
$10K.
$10,000. Add that to the IRA income of $40,000. So our provisional income now is $50,000.
That's okay.
Okay.
50% of that.
So $50,000 minus $44,000, which is one of the thresholds for married filing jointly.
Okay, that's $6K.
Oh, let's skip my thing. Okay, so that's, yes, $6,000. And in that threshold, you're going to pay 35% tax rate, which is $2,100.
Wow.
Yeah. Okay. Now, let's go down here. This is the exact same amount of money. These people earn the exact same amount of money. Ready? $40,000 in Social Security and $20,000 in IRA benefit. Now, you add those together. Remember, you have to cut your Social Security in half. So $40,000 divided by 2 is 20,000, and then you add that to 20,000. You got
40.
So their provisional income is 40,000. 40,000 in provisional income. Now, when you do the standard deduction here, 40,000 minus the 32,000, or wait, that's the different threshold. So they're in the $32,000 threshold. Oops, sorry. Which means that they have 8,000 taxed at 50% or half, $4,000. What happened?
No phone call.
Oh, okay.
Was a mistake.
Okay, so in this case, there's $0 over the threshold, which means this person's total taxable benefit was $4,000. The above person was $11,100. Oh, okay. Well, we're wrapping up. The point is, how much you receive in Social Security versus how much you receive in other income is not going to be depicting your taxes. These people earned $40,000 in Social Security. The other couple earned $20,000. The people with $40,000 paid no taxes. The people with $20,000 paid high taxes because of their IRA income, throwing them over that limit. All the more reason why you should do a Roth conversion.
Who was more benefit? Who did it look like to you?
The lower your IRA income is, the better off you are for Social Security tax.
The least amount you can take in your IRA will reduce your tax burden.
But you can't wait until, don't wait until you're retired and in your 70s to start trying to convert out of IRAs.
Make sure you know have your strategy and have it figured out, and not be in the middle of it and then trying to figure out what am I going to do.
Well, if you didn't know that retirement taxes were confusing before this show, you do now. I think I'm confused.
They are very confusing.
We covered a lot of different topics, but I do think we talked about a few things that are imperative, and that's how we are taxed, how more complex it can be when you're retired, and how Social Security falls in. We didn't even get to how much you can pay in your Medicare premiums. For example, if you do end up getting more than $194,000 in income in the first bracket, it jumps up from 164 to 230, but that's time for us. We'll talk about Medicare premiums another time. I just want you to know we're very thankful that you tuned in today. You can find us online, MindieMolina.com. You can call the station, but be blessed, be safe, and know that God loves you and there's nothing anyone can do about it. Thank you.